Welcome to the daily update, where I'll go over the action in the market for Wednesday, March 26th, and we'll see how things look for Thursday, March 27th. Had a bit of a down day. Now, on the negative side, we're back down below the 200-day moving average for the S&P. On the positive side, not an awful lot of technical damage was done. Now, if we see more follow through to the downside, that's going to change. But the subtle improvements that we've been seeing are, for the most part, holding up. And I'll go through the charts and show you. And maybe folks were getting a little bit too complacent that we were going to go up from here. Now, one thing that I will point out with the 200-day moving average, if that is solid support and we finally break above it, it's very strange for us to come back down to it so quickly. We were just down there not too long ago and we came up from it. Now we're coming back down. Just keep an eye on that. That could mean that maybe that support level is not going to hold because it hasn't held so far. We're below the moving average again. We're right at the simple moving average for the 20-day short-term measure. And so we're still considered positive in the short term. We're still positive in the long term, but we're mixed because we're positive on a trending basis, but we're below the 200-day moving average. So a bit of a mixed picture there. In the intermediate term, we're negative, but we're seeing some signs of improvement, even with the down day that we had on Wednesday. Now, again, some things fell apart, but we're seeing more of that rotation, more of a defensive type of posturing where growth is taking a big hit. The more defensive areas are, they were actually up in the session on Wednesday, and that's usually what a market does before it gets ready to go down. So we're just aware of that. We're not really seeing any improvement with our growth to value ratios. In fact, they're starting to get a little bit worse. So one point to bring up is that for Friday, March 28th, I will not be able to prepare a video. I have a short-term trip that I have to take that'll be during the time when I usually prepare everything for this video. And rather than push that back over the weekend and do this traveling then, which I could have done, I decided to go on Friday because then I can get back and then start doing the weekend videos. So that's the rationale that I used there. So just be aware there won't be a video on Friday. All right, let's go back and talk about what happened. Most everything happened after the open. We Tuesday was very boring. We came down, set a range, and just drifted sideways from that point. And so the pivot points for Wednesday were not very far apart. That's why we hit all these levels pretty quickly. So we had a flat open and we're just kind of chopping around a little bit. And then we just fell down below the unchanged level. Then we kept going down below the daily pivot at 57.75. Kept going then down to S1, 57.62. We broke through S2 at 57.48. S3, which that's when I have to break out the pivot point calculator and actually put these on the chart myself. That was at 57.22. We finally found support at S4. We don't hit that very often. That was underneath 5,700, and we hit that at 56.95. That's when this decline stopped, and that's why I stress the importance of these pivot points. They're on your screen before we even get there. And so we can be watching these things to see if they offer some kind of support. Or if we're going up, then we have resistance points as well. All right, then we bounced up to close. We got back above 5,700, but we still closed below S3. We were down 1.12% and get this, we were below average with volume. We've been below average with volume. You would think a big down day like we saw on Wednesday, there would be a big increase in volume. That didn't happen. When we've been going up, now when we're going down, we're seeing all of this actually taking place on below average volume. So, as I said, we're hanging on to barely being positive in the short term. We're negative in the intermediate term, and we're mixed to positive in the long term right now. Interest rates really didn't play much of an impact. It didn't have an impact in the session. They went up a little bit, and the dollar went up a little bit. The inflation, we should get an update in Friday's session with the core PCE coming out. So that's something to be aware of there. And this has to do with the tariffs and what's it going to do to the economy? What's going to happen with inflation? So that's what's producing a lot of jitters in the market right now. Okay, the S&P is back down below its 200-day simple moving average at 57.56, and the Dow is now back to being negative year to date. It had gone positive, not after Wednesday. And we closed right at the 20 period simple moving average for the S&P. And mega caps, they're the ones they took things lower. They really underperformed. Semiconductors were very weak. That took the whole tech sector down. It was the worst performing sector in Wednesday's session. And the defensive areas were actually positive. I'll show you that here in a little bit. The areas that we watch to see, okay, are we seeing buying in this area? That's where we saw the buying. We're seeing selling in the growth areas. And President Trump is expected to announce tariffs on auto imports, and that's what rattled the markets. The VIX is still under 20, though. That's one positive thing. It went back up, but it's still under that 20 level. We're coming in at 18.33. And we only have one thing. The Stochk RSI is still extreme positive. Now, we don't have any other short-term indicators that are suggesting that right now. We had a little bit longer of a list after Tuesday, but the Stochk RSI is still on that list. And then we're oversold with the slope oscillator. That's our short-term momentum oscillator, but it's positive because it's coming up and it's above its moving average. So even though it's giving an extreme negative reading, it is considered to be positive right now. And then the CMB composite really didn't move all that much. It's another oscillator, and it's still giving us an extreme reading. And that's more in the intermediate term. That's where I say ITOB, intermediate term overbought. So that reading is still valid. And we still have a non-confirmed Hindenburg-Ullman. We have until the 31st, which will be Monday, for another spike on that chart. And if we don't get one by March 31st, then this Hindenburg-Ullman will go away. And no changes to the scenario where the Fed lowered their growth rates according to GDP, which we're going to get another read on in Thursday's session. Now, we've seen this report 2 times before, so it's probably not going to have that big of an impact on the market unless the numbers are drastically different than what we saw last time, either positive or negative. And they're not cutting rates. They've told us that they're not going to be doing that. And they've also increased their inflation outlook. The dollar was up, interest rates were up. We closed at 4.34% with the 10-year yield, where after Tuesday, we were at 4.31%. Sentiment, we're still under or still above the 25 level where we came down. That's extreme negative for sentiment, and we just camped there for a few weeks. We went up one tick to 29 where we had been at 28. We were showing some improvement as far as sentiment is concerned, but not as much as we would like to see. But to have this tick up on a down day like we saw, kind of interesting. And the 10 to the 3 month yield curve, which we've been watching, it's not inverted now. It's a couple of days that we're not seeing an inversion with that. We are negative with the trend. It looked like possibly if we had had a good day on Wednesday, we might possibly shift over to a positive trend. That's at least delayed for right now, if not canceled. We'll have to see how things go. But we're negative because the red line's above the green line. It's a weakening trend because it's below its moving average, but it's still above 20. So we are still in a trending environment. And with the down day, the bias is negative, and I put our momentum back to mixed. You've got a really confused market right now. Everybody has an opinion, but nobody seems to really nail what's really going on because things are happening so fast. So we did get the weekly MBA mortgage applications index. It was down 2% for the past week, where the last week that we had, it was down 6.2%. Durable goods, this actually came in stronger than expected. These are bigger items that last longer. It came in up 0.9%. Last time it was at 3.3%. So down from the previous reading, but they expected it to be down 1.2%. If you take out transportation, it was still up 0.7%, much more than the 0.1% they had expected. And last time, that's the same reading that we had, up 0.1%. So here's a chart of the mortgages here where we're negative, but we're less negative than the week before. And a lot of this has to do, I mean, housing prices are going up. That's what the charts we've been seeing. If interest rates are going down, we see people running in and getting mortgages. If interest rates start to get higher, then we see that really backing off. Then durable goods orders year over year, we're right down here at the zero level. Not really seeing much in the way of strength that way. And then if you take out aircraft, we're actually down below zero. But see how we've been chopping around lately. We're not really seeing any definitive trend. This is how some of our stock charts are looking right now. And then month over month, where we were positive, but down from the previous reading. Then looking at the bullish sentiment score, getting a very low reading here, down at 2. All right. And that's goes in with our sentiment indicators and other sentiment gauges that we look at, and then some that we look at just on a weekly basis. Sentiment is very pessimistic right now, and this is usually indicative of some kind of bottom in the market. Well, it looked like maybe we were coming up out of that, but Wednesday threw all that back into check. And then this is a chart that I show this, and I'll show the chart that I usually show right after this. But this is the spread between risky and not as risky bonds with some standard deviation lines put on here. And so you'll see the same chart that I bring up. We want this to be low. If this really starts to go up, you see other times, this was the COVID crash, this was 2016, this was the great financial crisis. It had been coming back up lately, so we're watching that chart. But lately, it's been starting to come back down. And here's the chart that I usually show. So it's the same thing that you just saw. I just don't have the standard deviation lines on there. Okay, then looking at the forward PE here for the S&P 500, and that's what we're seeing a lot of. When we start to go down, it's like, well, what's causing all this? Well, maybe we're getting out of hand with earnings. Whether we look historically at earnings that have already come out or earnings that are projected into the future, you take it all together, we're right around 21. We're probably down closer to 20 after Wednesday's decline. But then you look at the equal weight version of the S&P, and it's more fairly priced. It's just a little bit above that 15 level. And then this is confidence. Chief Executive Magazine CEO confidence falling off a cliff right now. There's a lot of uncertainty about what's going to happen. And small cap equity positioning, seeing a lot of that coming out. The small caps were supposed to be doing pretty good, at least up until about the middle of March, right about now. And that should have started back in December, carried through January, February, and up to this point. And it never materialized. And so people are getting out of the small caps. And then I do cover this in the intermarket analysis video over the weekend. I showed this chart a few years ago, and then they changed it. And I found the new version of the chart, and this is just lumber. We mainly follow this for inflation purposes. And we can see that this is really going up, and if you need lumber to build a house or build a tree house, it costs more money. That's inflation. And then swings in oil, 10-year yields in the US dollar have been quite consistent recently, where we're seeing these pretty much move hand in hand. We look at oil, that's been going down, that's purple. And then the 10-year treasury yield, which has been coming down, it's been behaving fairly well. And then you have the dollar over here as well, and they tend to move more hand in hand with each other. And then after a series of declines, the consensus probability of us going into a recession in the next 12 months, it started to move higher again. That's according to this. But now I'm talked about the 10-year to the 3-month. The one that people follow the most is the 10-year, 10 to 2-year. And that's what's being plotted here. But the 2s to 10s, they just reverse it. The yield curve, a classic leading indicator, has not seen a notable flattening, or nor have we seen an inversion since it went back to being regular again. So this is not necessarily warning of a recession. And then the on-risk appetite has reset, but only to neutral levels. It's coming down here. Maybe it's dropped a little lower after Wednesday's decline. European stocks, they're just doing really well right now. And so far in 2025, they've really outperformed US stocks. All right, I didn't spend any time on Twitter. I just needed to get things prepared here. So here is the chart. Now it looks a little bit scarier because we shot up in Monday session and then just drifted sideways. Then Tuesday, we just kind of floated around here with no real conviction. Wednesday was the only real conviction-filled day, and that was down. And so we were flat when we opened, and we dropped below the unchanged level, below the daily pivot, below S1, below S2, and then down. We tried to set up some support here at S3, came all the way down to S4. This is where we finally bottomed, and then we bounced up off of that, but still below S3 for the day. And just looking at this, we were down a little bit with the futures, and now, right as I started to record, we're slightly positive, but this is many hours before the market opens. So you can see in the initial overnight session, and even when the futures open, we dipped down a little bit here, but then we came back to the unchanged level. They actually improved. So this big sell-off wasn't really preceded by any action in the futures market. This is what's causing us some concern, where we see the red line above the blue line. We want the blue line above the red line, which is growth. And that's not what we're seeing. You can see where the blue line really went down because growth got hit, where we were, on this chart anyway, almost unchanged with value. It actually held up better and saw advances in a lot of the areas. This is also not doing all that well. The growth to value ratio intraday for the S&P, we were hanging in there trying to show some signs of improvement, but then pretty much gave that back in Wednesday's session. So looking at the end of day, growth was down over 2%, where value was virtually unchanged. And it was down more for the mid caps as well as the small caps. So growth just got shot on all the different levels here. So we're coming back down. We've been chopping around underneath the 200-day moving average with the small cap growth to value ratio. We were improving a little bit more with the mid caps. Now it's starting to come back down and chopping around again underneath the 200-day moving average with our S&P growth to value ratio. And coming back down below the rainbow where we were starting to see some signs of improvement with this growth to value ratio, but now it's showing more weakness. And discretionary to staples was trying to show some improvement down here at the bottom, but it gave back a lot of those gains as well. So our trend, we are weakening because the black line, which is the ADX, it's going down and it's below its moving average. Now we were coming down with the red line, we were coming up the green line, but then Wednesday happened and now we're going back up with the red line and down with the green line. So it's a little more negative. It looked like we had a potential for a cross here. And we were also seeing that in the short term. You see how close the red and the green line got to each other? Didn't quite work out, at least for now. But if you look at the chart pattern up here, we're still setting a series of higher highs and higher lows because we gapped up in Monday's session, and then we've come back down and kind of filled a little bit of this gap here. But this is still looking constructive when you take all these bars together since we finally bottomed a number of sessions back. So all hope is not lost, but don't inside the market, we don't like this defensive posturing that's going on. This is what we saw in late 2021 going into 2022, which led to the bear market that we had in 2022. So we're just concerned about that. And it could develop into something like that. But for the time being, we have been seeing some signs of improvement. And we're still below average with volume based on this chart. And you can see over here, when we're red and below the midpoint, that means we're below average with volume here. Sentiment coming down with the Ulcer Index, but we're still above the moving average. And we ticked back up, but we're still below 20 with the VIX, both with the line chart and the bar chart. And the VIX of the VIX, since we had a down day, it's picking up a little bit in the volatility of the VIX. But the momentum of the VIX is still down, and that's more positive for the market. We went up with this fear gauge, and we just ticked up barely here with this fear gauge. So not a real strong confirmation there. And we really went up with the equity put call ratio. A down day like we saw, a lot of people are hedging. They're buying more puts than calls to protect their investments. And so we're going back up with the 5-day chart and the 10-day chart, and that's more negative. That means there's more hedging going on. There's more fear in the market. But look at the volatility risk premium continues to go down. It's still dropping off. It's not picking up a real increase in fear here. All right, and the advanced decline line holding up. Didn't really see any weakness here. That's because we're seeing more of this rotation. It's not money coming out of the market. It's going from one part of the market to the other part. It's going from growth to value. And we're even holding up here based on volume. Still looking okay. Even with the down day, we did set a lot of new highs. That's the green histogram here. But we did set some new lows. Now, we didn't set a lot of new lows because we weren't here very long ago. So these are 52-week new highs and new lows. But apparently there was more new highs here that were generated, but not as many new lows. So we're still going up with the 5-day chart and we're going up with the 10-day chart as well. So this internal measure shows the index is holding up. And we're still above the zero level for the short and intermediate term advanced decline ratio. Accumulation distribution, this is smart money indicator number one. It came down, but it's still well above this moving average. But it's still positive. And we're still positive here with the chicken money flow. Now the histogram was sideways, but we're still going up with the red line. And we're rolling over a little bit here, but we're still just a little bit above the moving average with the chicken oscillator. So this smart money indicator is also still positive. All three of our smart money indicators, they took a hit, and any more weakness could change that. But at least after Wednesday, they're still hanging on to being positive. And didn't really see any change here with the vortex. The red line is still coming down, and the green line flattened out here, but you didn't see the red line really spiking back up. And we're still positive this way. We're still above the moving average with the S&P, but when we look at the other indexes, the NYSE common stock, mid caps, and small caps, still below their moving averages, and they did decline. Or the S&P advanced decline line was almost flat. And we're still above 50 here with those stocks inside the S&P above their 20-period moving averages. This actually went up a little bit here. And we're still seeing some improvement with the 50-period moving average steady and a little bit of a tick up with the 100. And we're just turning back up, but still under 50 with our 200-period moving average steady. So not a lot of damage here. In the short term, it's kind of hard to see these things because the pivot points for April are now appearing on the screen, but we're back down below the 200-day moving average, and you can see there was a drop off in volume. We ticked down a little, but not really any conviction overall with our 20, 50, and 200 period moving average steady, but we're still extreme positive. Now we came down and we see more weakness. This is going to drop, but this is hanging on to being extreme positive, which suggests good short-term momentum. But we're not seeing any confirmation now with our other short-term indicators, like this one. We just started to come up into an extreme positive reading with the Williams percent R. Now it's dropped back down. We were almost there with the CCI 14. That's dropped down. The CCI 20 is still above the midpoint, but it had not gone all the way up to being extreme positive. We don't have anything on the stochastics chart where we're starting to get extreme in the short term. Now it's pulled back, but we're still going up in the intermediate term and trying to still improve here with the long-term stochastic. And we're back down just barely below zero with the force index. So that's turned slightly negative. But we're holding up okay here. We're still above both of these lines with the double and triple exponential moving average study based on 20 periods. This is the short-term trend. We're still, and as long as we stay above these lines will keep going up. So we'll see if we can get some of that back. And we're right at the 20-period simple moving average. We closed right there. That's why I'm still calling this positive for the time being with the short-term time frame. And we did drop a little bit below the midpoint with our standard deviations chart. So that's more negative. Intermediate term coming down, but still above zero with the balance of power. The CMB composite, this is still on our extreme list. It's coming down, but it's still above the black line. And we're still more neutral now with the go, no-go system with the lighter purple bars. And we're just a little bit below the midpoint here with our highest high, lowest low value chart, but not really hitting either the highest high or lowest low part of this channel. This is the condition of the intermediate term trend. We came right up to this blue line, which is a double exponential moving average based on 50 periods, and we're coming back down from that. We need to get back above this and then see the lines turn up to show some improvement in the intermediate term. So here's all of our moving averages. We're still below the 50 and 200s. That's why the intermediate term is negative. We're right back down to the 20 period simple, and we're back below the 200 period simple moving average. We're still hanging out just a little bit above the 200 exponential moving average, which earlier on, this has been for 3 days, this acted as overhead resistance. We were finally able to break above that. Now, this could potentially be acting as support. And now we're back down below the 200-day simple moving average. And we're still holding up here. This blue line going back to the low set a year ago, April, we came down and closed just a little bit above that with our anchored moving averages. The TTM squeeze is still going up. That's positive. And we're still above the moving average here with standard deviation as we've been chopping around lately. The ease of movement still improving, but negative. And we're just flat with the Arun, but that's negative. And we came down, but not a big move to have over a percent decline and see the McClellan oscillator barely move. That shows rotations going on, and that's a bigger picture negative if we're seeing money coming out of growth and going into value. So we're still going up with the summation index based on price and volume. And we look at the NYSE McClellan oscillator, it declined, but it's still above zero. So the summation index for the NYSE is going up based on price and volume. But we're still declining here with the Switzerland trading oscillator. It's actually been going against some of this improvement that we've been seeing. So we're declining based on price and volume here, but both are still above zero. Momentum is still turning more positive, though. The PMO's coming up after being extreme negative and crossing above its moving average. We're still going up based on price and volume. Our studies didn't see much of a change with the PMOs that are rising. They actually ticked up just a little bit. And the buy signals are still going up, and we're still flat with the PMOs that are above zero. And we've gone from positive to neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. This is the slope oscillator. We're still, until we get it back above this red line, it's considered to be extreme negative. But it's positive because it's coming up and it's above its moving average. And the MACD is still positive. So all of our oscillators, short, intermediate term, those have all turned positive. We're seeing improvements with the long term. We're starting to cross above the moving average here with the KST, a long-term oscillator. We're not quite there yet with the tricks. Copy curve is still positive. We declined a little bit with the Sean trend meter, but it had been improving. And we're still below 50 with the money flow, where we're still above 50 with the ultimate oscillator. We're still above the moving average with unbalanced volume. And we came right back up to the 50 level, and we're coming back down with the RSI intermediate term based on 14 periods, where we're dropping back down below 50 after crossing above it with the short-term RSI based on 9 periods. The bullish percent index continues to be positive. And we're going up with the NYSE bullish percent index, but we did tick down because it was the NASDAQ 100 that got hit with a lot of the mega caps in there. So that's coming down a little bit, but it's still above 50 and it had been really improving. We're waiting to see if we cross down below this red dashed line, that would be a signal suggesting a reversal, but it has not happened yet. And we're back down. I stopped using the Fibonacci chart because we were starting to come up out of it. Well, now we're back down to the 61.8% retracement level. And that's about where we hit the bottom. And we're still just a little bit above that level. Longer term, though, with the weekly chart, we're still above this pivot point. So that's holding long-term support for right now. And we're still looking positive for the most part here with the Heiken Ashi. We're positive since we're black with the Kegi chart, but we're pointing down. So that has more of a negative context. We're still positive with the Renko chart, and we're still positive with the three-line break chart. Long term, still trying to show some improvement here with the 150 and 200 period moving averages, but they were pretty much flat. And so we're back to negative in the short and intermediate term with all the stock indexes that we follow. And commodities are back to positive across the board. Bonds are still negative in the short term. And we have the dollar negative in the short and intermediate term. This is what I'm talking about. The areas that held up, staples, utilities, energy, real estate, those are the areas that did the best. And those are defensive areas typically. Where the bottom three, communication, discretionary, tech, these are growth areas. And they're the ones that got hit the most, with tech being down really more than anything else. So an awful lot of red with a little bit of a bullish percent index for the energy sector going above 70. But you have the NASDAQ just going 18.2, 18.1, 18, 17.9. Then the S&P did get below 5,700, but we were able to come back and close slightly above it. And the Dow is still above its 200-day moving average. We're still positive with the Elders Impulse system for the Dow. And we're still below the 200-day moving average with the NASDAQ. This hasn't been really performing all that well. And kind of the same thing with the NASDAQ 100. And we've gone from positive to negative, though, with the Qs when looking at the Elders Impulse system. But the momentum for the NASDAQ 100 is still positive. Small caps just not really doing all that well here. It's seeing a recent death cross here with the S&P 600. And then we look at the Russell 2000 small cap index generating a death cross here now too, dropping below 50 with the RSI, but the momentum is still positive. And we've gone from positive to negative now with the small caps. Mid caps also took a bit of a hit, like everything else, and dropped down below this pivot level. But we're still positive with the Elders Impulse system. When looking at the mid caps, we came up to the 200-day moving average with the Wilshire 5000. Now we're dropping back down below it, and we're dropping back down below the 200-day moving average with the total U.S. stock ETF. Financial sector is still above its 50-day moving average and wasn't down all that much. The FANG index was starting to come above its 200-day moving average. Now it's right back down to it. And this is the mega caps. The dollar is seeing a little bit of a rebound here, but it still has not been able to come back to its 200-day moving average. And then Apple, it ended up being down 1%. We're in danger of seeing a death cross here with the trend. Amazon came right back down to its 200-day moving average after it was able to get back above it. Microsoft, which is in a downtrend, it was down 1.33%. Facebook bounced up off of its 200-day moving average. It got hit too, down 2.45%. And Google, which is under its 200-day moving average, was down 3.22%. Nvidia, which is now starting to be in a downtrend, that's a concern. It started to improve back in late 2022, and then it's been in an uptrend since early 2023. Now we're starting to see a downtrend here. And Tesla came back up to its 200-day moving average and then fell 5.58%. And then we look at U.S. stocks on a short-term basis versus world stocks. Not much of a change here. Still seeing a decline with the longer-term correlation. And we're still under 70 with oil. That's not really producing any of the problems right now. It's other things. And for some reason, I have Netflix on here again because I hit the wrong button. Okay, something's going wrong here. Okay, sorry about that, folks. And I don't want to go back and redo this thing again. I hit a reset button on here and things didn't work out all that well. So I apologize for that. Okay, then looking at bonds, we were up just a little bit with the 10-year yield. We were down a little bit with the 10-year based on price. And we were starting to see some improvements with our growth to value ratios. No, not now. We're back down with the Qs to S&P. We're still above the moving average with discretionary to the S&P, and we turn back down when we compare large cap growth to value. And here with the large caps back under the moving average, dropping back under the moving average with the mid caps and the small caps. So what's our outlook for Thursday? This is a real hodgepodge. We're still positive in the short and long term, depending on how you define positive. I define it by the 20-period moving average in the short term, but we're mixed in the long term since we're below the 200-day simple moving average, but we're still above that long-term support on the weekly chart. We're going to get jobless claims and then the advanced international trades in goods, as well as advanced retail and wholesale inventories. Not a big influential report. We'll get the third reading of GDP, and then pending home sales will also be coming out. And then all this stuff going on, tariffs, Doge, geopolitical, Russia, Ukraine, Israel. Any one of those things can come to the forefront at any time. So then on Friday, we will get the core PCE. That's probably about the third most important economic report of the month. The first one being the employment situation. The second one being CPI, that's inflation. The third one being core PCE. That also measures inflation. And here's another look at the economic calendar. Then seasonality for March 27th, we're neutral to negative. So a slight negative bent, but not overly so. And we're still dealing with the week after options expiration, which is down 38% of the, excuse me, I always get this mixed up. It's only up 38% of the time. It's down 62% of the time going back to 1980. And then we do see a little bit of weak seasonality here as we try to finish out the last day or so of March. But then we see a little pop as we finish out the rest of the month. And the second half of March, it's been all over the place. The first half usually does well, not this year. We were starting to see some improvement in the second half. We're wondering if that's now in jeopardy. So the warning signs, the negative things is we're going up with the 5 and 10-day equity put call ratio. The swollen trading oscillator is going down. The moving average studies, they're still, the 20 period's holding up, but the other ones are still below 50. And the ease of movement is negative, as is the money flow. And then the vortex is negative, didn't really change, so it's actually improving a little bit. And then we have a long-term chart that I only show when we actually generate a signal called a special K. That is long-term negative. Then on the positive side, we're still hanging in there with our three smart money indicators. Now, longer term, the growth to value ratios are still in uptrends, but man, they've been getting hit in 2025. So you could possibly put this over on the negative side. And our oscillators, they're improving. We're still positive in the short term. We're turning more positive in the intermediate term. We're getting better, but still negative with the long term. And the S&P and NYSE McClellan oscillators, as well as summation indexes, they took a hit, but they're positive. And our bullish percent indexes took a hit, but they're positive. The parabolic SAR is positive. The Copic curve is positive. Financial sector held up fairly well. And banks are still above their 200-day simple moving average. And then the ultimate oscillator is still positive, as well as the momentum for the NASDAQ 100. So our conclusion, this is where it's crazy. We're positive in the short term, but negative in the intermediate term. We're mixed in the long term because we're below the 200-day simple moving average. So that's what we have for the short term. We're negative in the intermediate term, but we're still seeing those signs of improvement. Now they could go away if we see more selling, but they're still hanging in there for right now. And as I said multiple times now, we're still mixed in the long term. Thank you. I hope you found this helpful. I hope you have a great day. And the next daily video I'll be doing will be for Monday's session.